We have Mr. Pradeep Rathod. He is the chairman and managing director of the company. He has more than 40 years of experience in the business of manufacturing and trading across the different segments, sub-segments, whether it is plastic materials, thermoware, consumer wear, as well as the raw materials and the ingredients that go into it. We also have Mr. Atul Parulia. He is the CFO of the company. He is a chartered accountant and company secretary and has more than 30 years of experience in finance and accounting. On the dais, we also have the fellow bankers from IIFL Securities, ICICI Securities and JM Financial. A couple of lines on CELLO World. Needless to say, it's a well-known household brand. But one of the important aspects is that it commands a leading position in the consumer wear industry with products in glassware, opalware, melamine and porcelain categories, writing instruments and molded furniture. One of the key statistics is that of the three broad categories, consumer houseware constitutes almost 66% of the revenues as of FY23. The writing instruments and stationery is 16%, and the molded furniture and allied products is 18%. I think this is an important aspect that adds to the brand of the company. Little bit about the IPO. The IPO is for a size of 1900 crores. The price band is 617 to 648 rupees per share. The anchor date is October 27th, which is Friday. The issue opens on Monday, October 30th and closes on Wednesday, November 1st. The issue is for QIBs 50%, retail 35% and non-institutional 15%. With that, I will request the management to go take you all through the presentation and
for the IPO meet. CELLO is a consumer wear company and it's been from 1982 we are into this field. We started our journey with plastic houseware and then went into an adjacent field of insulated wares which keep food and beverages hot and cold. From there on we in 94 started our molded furniture division, which is under the listed entity Plus Limited. In 95 CELLO started writing instruments, and CELLO writing instruments in 6 years was at the top in top line and bottom line both. The journey started from there. In 2017 we entered into glassware because we wanted either two fields. One is if our sales was aligned or our manufacturing process was aligned. So till 95, till the writing instruments, our manufacturing process was all aligned. But we wanted to go into a consumer wear company, not only a plastic consumer wear company. So we entered into glass and stainless steel. In 2017, we first time put a glass opalware manufacturing furnace, which is a 52 tons furnace. And last year we achieved a turnover of around 276 crores in that. And further we have put a new furnace which is started in August of this month, scaling up our capacity in that. Beyond that, we felt that there was a lot of gap in the writing instruments industry. Though we had exited a JV with one of the international companies, we re-entered into writing instruments with a new brand name Unomax. And because of our experience and capabilities in writing instruments, what we had done over 20 years, we could take it to 285 crore rupees turnover last year in 3 flat years of starting the new brand, and with a brand new, with a new brand which was not known in the market. We did the best EBIT margin of around 23% in the industry, which is almost 40 to 50% above most of the peers. So this are all the verticals in 2020. Then we started consolidating all our businesses under one entity of CELLO World Limited, which we took around 2 years. Then we had a PE investor, two of them, ICICI Venture and Tata Capital, and thus taking us now for an IPO. Last year, the total turnover of the company was around 1800 crores with a 285 crores PAT. Historically and philosophically, whenever Cello has worked, Cello has grown at a good space in the market in most of the fields where we are working, and we have taken either the top 3 positions in all the fields. We had one philosophy right from day one. We never only wanted to grow our top line, we always wanted to have a very healthy bottom line. That's why our return on investment, if you see, are amongst the best in the peers. And in future we also think of going in the same way to maintain our bottom line. Last 30 years, Cello has never borrowed any external debts, and that was just because of our healthy bottom line, what we could maintain and grow. It is a very well-known brand. We have our brand ambassador, Amitabh Bachchan is the brand ambassador from last 5 years for the company. He's giving the company a little more highlight in there. We use not very high, but 2 to 3% on our advertising cost for making up the brand more and more visible. Our main consumer, our main decision maker is a housewife in most of our products, and we always wanted to create adjacent category where Cello brand could lead that and take it to be known in an adjacent field. Like what we have entered lately is cookware and small home kitchen appliances. We feel the same consumer is there when a housewife who is the decision maker in most of our products, when she sees a mixer from a company which has been giving good product, quality products and affordable price from last 30-40 years, attraction to go and buy even in that category increases. We have a diversified portfolio, which also is the strength of the company. We could maintain and grow in each of the verticals, and I think so for the next 3 to 5 years in all the categories where we are, we see very high growth potential over here. Thus, we would like to grow at a healthy rate in future too, as we have done in the past. Thank you. So this was just a brief what I could give about Cello and where Cello stands today. I'm ready to take any question answers whenever you want on this. Thank you.
Where is the majority chunk of this funding going to go towards?
Majority?
Chunk of this funding that you're raising?
So it is all to the promoters, because neither the PE investors are selling. So it's all 100% of it is from the promoter family.
There is no primary.
There is no primary, and neither is the investor selling.
Anjali Kedia from SDHN.com. I want to understand a little more on your business. You say you entered the appliances category because it was the same decision maker. But since it's a very crowded market, I don't know if you are even breaking even in that market, in that segment at the operating level.
No, so we are breaking even and we are doing a healthy margin because it's just started 8 to 9 months back. Okay, it's a vertical which was up to 35 crores last year, and we are growing at a healthy pace this year, and we do not want to really go. As I said, we want to be in the niche area in this product. So we have designed our own products, mixers and everything which are in-house manufactured. Cookware, though it is at the lower level crowded market, but if you see at the top 5, you wouldn't find any 5 names, branded players in that category, except some of them who are leading, and then you have a gap which is very wide. So, and as the nuclear family system and young generation, the cookware is completely changing from what it was conventionally there.
So you plan to go deeper in this segment
Yes,
as well?
but not as deep as that we want to be an appliance or cookware company. So we would be there in this area to grow from here at a healthy pace with a healthy margin. So we do not want to just penetrate and only grow our top line over there. So we'll be in very, very niche product over the next, when you see, I think so there are some catalogs which would be here. So I will show you on that product. What are we doing different?
So the share in revenue mix will remain less than 5%, you're saying? Because you're not very...
100, not more than that.
Secondly, exports are also about 10% of your revenue. Is that white label or is that within the company's brand? And how are the margins there with respect to domestic market?
So all 90% of this is with the company's brand. The biggest segment in our export is riding instruments, because India being low cost manufacturing country because of our and hand assembly, where we employ highest women labor, that gives an advantage to India because we do not have to bring an automatic assembly machine, where we can give new SKUs much faster to the market, and that's why the export potential from India is very high on riding instruments. It's growing. Though we are not at the level of China or somewhere, but India would be standing at around second position in the world on exports. So the gap is very wide, but it's growing very fast. Our other consumer wear, in our openware, we are exporting everything with our brand CELLO only, 100%. Non-glass also we are exporting under the brand CELLO. So only 10% in the writing instruments we are doing ODM, where it's our product, our design, which we license to companies like Walmart and all, where they want their brand, but that is only 10% of the total export.
Next is, you have borrowings of 300 crores and primarily that is from related parties and interest free. Don't you think when you're listing this would lead to say corporate governance issues, or why not repay, you already have some cash on books? So that's a very small amount, but why it's still there from related parties on the books?
No, so it is not from related parties. When we started our consolidation from 2020 and taking up all the verticals by creating subsidiaries of CELLO World Limited, this partners capital was sitting at the lower level, which in fact turned to a loan. It was not a fresh loan which was offered by any of the directors today or any of the shareholders. It was just created because the total balance sheet size did not change. So at the operating level, we had 5 different partnership companies, which we then converted or slump sale to CELLO World Limited. So when CELLO World had to pay to this, when the slump sale happened, so CELLO World did not have that balance sheet size. So ultimately the money was from the promoters only in the business or from the partners. It remained in the same space. So we did not increase for our business purpose. It was only for the consolidated purpose. Over the next 2-3 years, it will be paid.
Lastly, last year in October 22, when ICICI Ventures and Tata Capital came in, based on their converted price for CCPS, the effective equity share price is 275.66 rupees. And now the issue is being made at 648 rupees. That's almost a 135% jump, when in the last 1 year, profits have jumped at 25%.
Right.
So what is the justification for this?
No, so there is no justification. I think so that was low. We were with ICICI from 2018. And really speaking, we were not very sure we would like to go or we would like to go, but we were in conversation for 4.5 years. And at late as August of 22, that we finally took a decision that we will get a PE in. Our relations, our understanding was so high, and that we also wanted that time. The price was not a major aspect or anything, because when we were talking in 2018, our openware and pen was not even existed. So that valuation was going on, and then we increased to a little bit, and we shrink the size also to a very less level what we were earlier thinking of. So that's why there is no justification to why the prices are so high today and why it was at a lower value of 6,000 crores. So that's just because of the timeline we were together and we thought to find as a good investor, so we would like to have, and our IPO came much faster. In fact, if it would have come after 4 years, the justification would have happened.
But the incoming investor will look at that price before subscribing to the IPO.
Surely, they have to.
That depends.
Not 1/4 the price. Today,
Or a 4-year back price.
So, just to add to that, the current price was determined basis of all the investor discussions that happened cumulatively, right? So it was a function of supply and demand. And they were very well aware of the fact that the two private equity investors invested at a certain valuation last year, right?